Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, when I was discussing this video with my colleagues, some of them felt that the title was too strong. They advised me to not use a strong and a scary word like crash and tone it down. And I guess they were right. But I said, what if I feel that there's a strong possibility of the Sensex crashing to 40,000 or so levels? Can I use it then? Well, they agreed, and I got to keep the word crash in the title. So why do I feel that the Sensex could crash to 40,000 in the coming months? Why am I so negative about the stock market? Let me clarify that I am an India bull. I think 10 years from now, Indian companies would be creating new profit records. The Sensex would be perched much higher than what it is right now. But it should be noted that I am a research analyst and I recommend stocks for a living. And I can't justify the salary I am paid unless I figure out a way to outperform the stock market. So if your goal is to not outperform the market and earn market-like returns over the long term, then there is no need for you to watch this video. Keep doing your SIPs and trust me, if nothing dramatically goes wrong either with the world or India, you will end up with a sizable corpus. However, if your goal is to outperform the market, then you should watch the rest of the video. I certainly have such a goal. My mission is to try and earn market-beating returns for my subscribers. And therefore, I look for ways to achieve this objective in a way that involves as little risk as possible. Today, I will share with you an important observation I made while studying the previous stock market cycles. I'm sure you are aware that the stock market does not go up in a straight line. It goes up and then it goes down some and then again up and down and so on. What I have noticed is that when the market enters a bear market, it usually bottoms out when it goes below the high of the previous bull market. So if you want to figure out how low will the stock market go during a crash, the high of the previous bull market should usually be your answer. Let us understand with the help of this table. As you can see, there are two stock market cycles here. In the first one, the index reaches a hypothetical all-time high of 100 and then falls to 70. In the next cycle, the index goes up from 70 to 150 and then falls below 100, that is 99. Now it's usually seen that the bottom of the second cycle, that is 99, is close to lower than the bull market high of the previous cycle, which is 100. So if the index corrects and goes below 100, it is usually a sign that the stock market may have bottomed and will now start a new bull market. Now let's see whether this has worked in real life. There have been 10 market cycles between October 1990 and March 2020, and we are in the 11th one. This means that there have been 10 instances where the markets have corrected at least 20% from the top before starting a new bull market. Take a look at the last market cycle on this slide. This is the period of the subprime crisis. The Sensex tops at 20,873 and then bottoms out all the way at 8160. This 8160 is much lower than the highs of the previous bull market. Also consider the dot-com crash where the Sensex fell from 5934 in Feb 2000 to 2600 in September 2001. This 2600 was again significantly lower than the previous bull market high of 4631 reached in September 94. All in all, in 4 out of the 6 instances on this slide, the stock market has bottomed below the bull market high of the previous market cycle. Well, the story of the next 3 market cycles is no different. Take the coronavirus related crash between Jan 2020 and March 2020. The Sensex bottomed out at close to 26,000 levels, which was again lower than the previous bull market high of 29,862. In the other 2 instances also the same story. The bear market has ended only after the Sensex has gone below the high of the previous bull market. So in 7 out of the 9 instances, this theory has proven to be correct. That's an accuracy rate of almost 80%, which is quite good to be honest. Now, what does this tell you about the current market? The previous bull market high was 41,953 for the Sensex, which was reached on 14th Jan 2020, while the high of the current market cycle so far is 61,766, reached on 18th October 2021. From those levels, the Sensex is already down more than 11% as I write this. Does this mean that we are in a new bear market and the Sensex could crash and go below 41,953, which is the high of the previous bull market? Well, both yes as well as no. Yes, because this is what has happened in 7 out of the last 9 market cycles. And no, because we are not in a bear market yet. The Sensex is down only 11% from its top and still has a lot of distance to cover to be in a bear market. If you think of it, so much has happened in India over the last 30 years. We had the 1991 reforms, the IT boom of the late 1990s, the economic boom of the 2000s, and another big ticket reforms like GST and the insolvency and bankruptcy laws. Indeed, the India of today looks a lot different than the India a couple of decades ago. And yet, despite all these changes, the behavior of the stock market has remained the same. It has gone up and then it has gone down and to below the previous bull market high. Therefore, do not believe anyone who says that this time it is going to be different. I don't think it is going to be any different going forward as well. The market will keep exhibiting the same kind of behavior. Now, as an investor, how exactly do you take advantage of this knowledge of the index? How do you try and ensure that this helps you in earning market-beating returns? We have all been told that in order to benefit from the long-term India growth story, you should always stay 100% invested in the stock market. You should not time your moves into and out of stocks. At all times, you should have 100% of your portfolio in stocks. But as we just saw, markets don't go up in a straight line. They take 3 steps forward and 1 step backward. This is how it has been in the past, and this is how it will be in the future as well. Well, I believe in taking advantage of this tendency of the stock market by shifting allocation between stocks and bonds. So if the markets are cheap, I recommend my subscribers to be 75% in stocks and 25% in bonds or FDs. And if they are expensive, I recommend them to do the reverse, 75% in bonds and 25% in stocks. I even run a service where I have been doing this for 8 years now. The CAGR, or the compounded annual growth rate, there is 21% versus 14% CAGR of the benchmark index, the Sensex. Right now, the split between stocks and bonds is roughly 50-50. That is 50% in stocks and 50% in bank FDs. As the market goes lower and inches towards the 40,000 to 42,000 mark, I will keep increasing the allocation to stocks. But if it goes higher, I will keep reducing the allocation further. This approach has not only allowed me to sleep well at night, but has also led to market-beating returns. So do remember that the markets just don't go from one all-time high to another. They always fall first and usually quite significantly. An investor who is looking to find an edge can take advantage of these fluctuations and earn market-beating returns in the process. Do let me know what you think of this theory by sharing your honest feedback. Take care, and I'll see you again next time.